Welcome back. Let us start the second important session on the GST. This is basically when we want to do things, it's important to know what we should not do. What are the common errors that can happen? How do we ensure that those things are avoided? So various aspects which need to be covered under section 35, subsection 5 also. So to touch upon this subject, we have got an eminent speaker. Speaker is none other than C.A. Rajesh Kumar T.R. Now I request C.A. Raghavendra to escort Rajesh Kumar T.R. to the dais, and also present a welcome to our friends. Rajesh Kumar T.R. needs no introduction for this gathering, I am sure. He has been presenting various papers on the various occasions all along the last year during the various GST seminars and all. But still, I feel proud to talk about him because we were studying together in this hall long back, before 2002 time. Friends, he has completed his CA and also LLB. He is currently the partner in Hiregange Associates, which is more than 30 years old CA firm, which is well known for indirect taxes. Currently, he is focusing on representing cases of the business before the different legal forums, and he has been the contributor in the form of articles and write-ups to the different professional journals, including ICI and KSPA also. He has been presenting various sessions, and he has been the speaker for the seminars and workshops of indirect taxes and also the GST held across the country. He has authored a number of books on the central exams, the service tax, the KVAT, and now the GST. He has contributed substantially for the compilation of the study material on the indirect taxes published by ICAI for CA final examinations students. He has been the faculty for the different programs conducted by the Institute of Chartered Accountants of India, and has been addressing the students. He has been invited as a resource person for the central exams and the service tax department for providing lecture to the departmental officers, and more than all these things, whenever we want to invite him, he can't say no. That's the kind of connection he has got with the institute. So therefore, though he has been extremely busy over the weekdays, still Saturday morning, Sunday morning, we invite him to come here. He readily accepted our invitation and he is here with us to address this second session. Ladies and gentlemen, please join me to welcome him once again. Over to you, Rajesh.
Good morning, everybody. Good morning. At the outset, I would like to thank Bangalore branch for giving me this opportunity for being here on the Sunday morning on the Gokulashtami day. In this entire program, since morning till evening, the focus is to cover the GST audit compliance aspects. Since it is being led by 3 different speakers, you may find some overlapping as well, but nevertheless it will be in a different context. In this entire GST, one, we may find the conceptual aspects, second, the procedural aspect, third, the practical aspect of it. So we are trying to cover in this as far as possible from all the 3 angles to enable you to address whatever the challenges which you are going to face when the actual audit it comes for you to execute it. When we talked about this particular program, we were having an expectation by the time we would have got at least the formats of the 9C or as well as the annual return, the 9, we would have got is what was the expectation. In fact, there was a talk which was going on that it will be released on the last by 30th of August, 31st of August it will be released. We were waiting till late evening that it may release, but we did not get any lucky with that. Nevertheless, with whatever the information available, we have tried to proceed in this context. In fact, the first session was to give you a connection between other audits and a distinction between other audits vis-a-vis the GST audit per se. Now, my role is to take you through a little more deeper into the specific aspects of the audit, how to do an audit in the context of this particular requirement. And the next session essentially is going to be the reconciliation statements. How to do and what all the aspects you need to consider while doing a reconciliation, and with some examples will be dealt with by Venu. And the last session we are keeping it for the panel discussion, especially open session, to address something which would have not covered or some doubts which would have been left open in spite of we covering this, or the critical issues which will come up, we will be discussing in the last session. So this is the entire gamut we were told in the beginning, but nevertheless I am telling now to have a connect with each of the topics per se. Now, to take my first slide, audit. We are all auditors. We know what's the meaning of the audit very well. But in the context of the GST, whether what we understand as an audit is the same thing what we are looking as an audit here, or is it different? That is the first basic understanding we need to have here. Here it is not that what we understand in general as an audit is what is required. Here it is a specific definition for an audit in the law, which we have to be very, very cautious about. Here, going by this, our scope gets confined. It is not that everything which we need to be looking into. We are supposed to be looking into only certain aspects of it, not beyond that. Is a very important aspect which we need to know going by the provision. In fact, Bharti did mention about it. Whatever the format they are going to come out with, obviously that cannot go beyond the scope of this. What all the requirement? It says examination of records, returns, other documents maintained or furnished by the taxable person under the GST law rules or any other law. So basically, you are going to examine records and documents. That's to put it as simple as that. But with purpose, what is the purpose with which you verify? You do not simply go through it. You have some objective in front of you. What is that objective with which you are going to verify these documents or the records? Correctness. Here you are not expected to give any opinion per se. It's a correctness of turnover declared, whatever the turnover declared, the taxes paid, refund claim, and input tax credit availed. Only 4 aspects have been specifically set out. So whenever they come out with any forms which you are required to submit, it will be only to this extent and cannot be beyond this, is a primary emphasis which you are to. And this correctness, when we are looking at it, to verify the compliance of the GST law. It's not merely okay, it's correct, no. Again, correctness should have a primary objective of ensuring the compliance of the law. If there is some procedural violation per se and all those things, that is not what is expected to be commented upon. Here, it's only a correctness is what is expected of to be verified and possibly to be reported. And there is a little of a conflict. I don't think that they have really thought well when they are designing this entire audit provision. They have merely probably adopted from some other state laws without actually going into the requirement of the GST law per se. Obviously, after maybe 1 year or 2 years, getting out of the experiences of the first year of audit, surely these provisions are going to get amended. Okay? The first question already would have been asked in the first session: is this a certification? Probably a sort of a certification rather than merely expressing an opinion per se. The last bullet point here: what if audit is not done? What if audit is not done? What will be the implication? Huh? Sorry?
Double task, looking deeply into the accounts and finally go for...
No, you don't audit. Client doesn't get his books account audited. What is the repercussion?
Penalty for non-compliance.
Sorry?
What is the penalty for non-compliance? That is the question.
Yeah, what? Where is the penalty provision for it?
122, 50
What does it say?
penalty non-finance information 10,000.
10,000 rupees, that's all.
See, 241, 5,000, 10,000. There is enough for that.
No. No, there is no specific penalty over here, so probably the general penalty will be applicable. There is 100 rupees for penalty, all those things is for the annual return, not for the audit. 35 audit, there is no specific penalty. If somebody is familiar with the VAT audit, initially when the VAT audit 240 was introduced also, similar anomaly was there. There was no penalty provision, which they subsequently amended to bring in a specific penalty provision. Here also, I am not finding any specific penalty provision to say that if you don't get your books of accounts audited, this would be the penalty. But general penalty of 25,000 CGST, 25,000 SGST. So that is what is the thing. And some people may say audit fee is more than, anyway, it's all members. Audit fee is more than 1 lakh. So better I pay 50,000 rather than. Anyhow, I am just putting the thing, that is not what is expected. Maybe there will be other repercussions from the assessee's ranking perspective, your rating perspectives. But nevertheless, I am just telling you, they have missed out this aspect, I feel. Before I go into the records, you may be already knowing what are the records which requires to be maintained. I have just listed out. This presentation will be circulated to you, so you can just see. Some of the slides is only for your information, may not be for the discussion purpose. But nevertheless, there is a requirement that you need to maintain certain record. You means the person who is registered person is required to maintain records statutorily to give a details of production, manufacture, inward supply, outward supply, stock, input tax credit, output tax, invoice, delivery challan, credit note, debit note, RCM invoice, advance receipt, payment voucher, import and export goods and services, opening balance, closing balance, the tax collected, tax charge, tax payable, all this information is statutorily required to be maintained. These are all called as records. Okay? I will come to this one later. I am just jumping to slides and going to this and I will go back to the thing. What does the provision says? Every registered person whose turnover in the financial year exceeds the prescribed limit, which is 2 crores, shall get his accounts audited by a chartered accountant or a cost accountant. Gets his accounts audited. This is a responsibility of a registered person, okay, not on the auditor. Gets his books of accounts audited and shall submit. Who has to submit? Registered person. A copy of the audited annual accounts. I want to note down, it is not an annual financial statements. I repeat, it is not annual financial statements, it is audited annual accounts. What is audited annual accounts? Nowhere defined. Okay? Why I am emphasizing this is, the compliance of the audit is at each state level, not at the entity level. Because this provision is there in the respective state acts. Also with the Central Act. So this reporting is at the state level. So your accounts cannot be an annual audited financial statement. There is one reference of annual financial statement comes later, but just keep it for the time being. It's only talking about annual accounts. So what is this accounts? What it should contain, what it need not contain is something which is still lacking. I can only bring a parallel to it. What are all the accounts which is relevant for the purpose of GST transaction? In the sense earlier, your balance sheet may not be relevant. It is more to do only with your earlier when your VAT audit was being done. They were expecting only for you to provide a trading and profit and loss account audited with the returns. Similarly here, the audited accounts confined to that particular registration transactions compiled in that format may have to be construed is what my personal view on this particular thing, because there is no specific, you need not give a total annual financial statement because it cannot be comparable or matched or these things. So therefore again when you are talking about an audited financial statement that is in a different law which Badri was mentioning, you cannot give that. This should be more specific to the accounts. Okay. So this is one important aspect I wanted to highlight upon. So this is going to be an independent preparation of accounts relevant for that registration. Practically when I take some of the aspects I will explain furthermore on it, but just I wanted to highlight this. Second, a reconciliation statement under section so and so, so and so. If we talk about this reconciliation statement is talking about a reconciliation between your whatever the returns with the annual financial accounts. So reconciliation between the financial statements to this, audited accounts is a separate and audited financial statements is a third one. Okay, such other documents as may be prescribed. When we talk about 44.2, which is I extracted below that, who is required to get account audited in accordance with so and so shall furnish electronically annual return under subsection 1 along with a copy of the audited annual accounts and reconciliation statement. Reconcile the values of supplies declared in the returns furnished for the financial year with the audited annual financial statement. Here they are using the word annual financial statement. As far as the reconciliation statement is concerned, your audited financial statement vis-a-vis your returns, the reconciliation statement, plus added on the annual account is an independent thing. So this is separate, reconciliation statement is separate. And as far as this reconciliation statement is concerned is what 9C talks about. 9C return format which is to be notified under the GST rules is this reconciliation. This is the third bullet point over here is what is expected, and it cannot contain any other details that I verified the books of accounts and I have audited. All those audited sort of a report cannot be added into 9C technically going by virtue of the act and the rules made over here. It should be only a reconciliation statement between the financials vis-a-vis your corresponding return. That is where the one probable or the tentative reconciliation statement which Badri projected it. So like that you take a financial, audited financial turnover, drill down, segregate the turnover relating to other branches, then take that, in that what is declared in the financials which will not be reflected in the GST return for whatever the reasons, that has to be excluded. then add what is declared in the GST return but not declared in the financials. So that reconciliation, there cannot be a standard format. It has to be varying depending upon businesses to businesses, situation to situation. Even though they may give some format, it will be only a guidelines for you. There will be always a residuary thing which says that any other matter which you are supposed to do a reconciliation. That is where, as a professional, our experience and our knowledge has to come in and supplement that particular format and give that certification process. Okay. So now, having made this aspect clear, that is, what we are supposed to do is auditing of accounts which is meant for this purpose, which is being maintained. That is where I talked about all this account of input, production. Here if you see, correct books and account at the principal place of so and so, what is received, what is consumed, what is things. So those are the accounts which we are talking about, and that format, how it is going to be, is not there. Again, there is no such prescription also to power to prescribe that format for that particular audited annual account. It may be a general thing which is relating to that. We may have to design. We'll wait for some time now and then go ahead with that particular. But for the time being, it's an annual account different from financial statements. This should be only confined to that particular registrations, turnover details, and the transaction related to that. Now, the issues which we may face when we want to take up the audit of any registration. It is not necessarily that all the branches of the different states will be given to one person for doing an audit. If there are 25 branches at 25 different states, or at least 25 registration in 15 states because of various business complexities, then each of the branches might have been given to audit to one different auditor. You may be one among them. Then you will not be able to get into other person's transactions, other transactions details. You are confined to your own registration, or the registration which you are supposed to do an audit. How we are going to ensure that something which is related to this has not got accounted there, or vice versa. So those are the challenges which we will have to face. Because head office will have upon branch, go down and all will be having only the specific things to that, and the entity level also there will be a challenges. What is that? That is where you may have to take a management representation. Other than what has been produced in the books of accounts, we do not have any other transactions which is accounted somewhere else. So such sort of a management representation we may have to take to at least ensure what has been given to us is only relating to that corresponding registrations, unless which we can easily identify through whatever the source. Okay. Again, when it comes to method of keeping of the records are concerned, different software may be having for billing. One software will be there. Inventory separate software may be there. Production, financial books, if they are being maintained in one software or multiple software, whether they are talking to each other, whether the data which is flowing from one of them to the other is in correct manner, all these challenges will be coming. So if we see many of these challenges, how to address that if we are asking, we have to go back to our basics or basics of our audit. That is, first of all, checking out the systems and controls. The systems and controls we would have been looking at earlier in the past only from the angle of financial prudence or the statutory compliances in the income tax perspective or whatever it is. Now we have to look at the systems and the controls in one more additional perspective of the GST compliance. Whether the system which is being maintained, is there a methodology to identify any invoice which is beyond 180 days not being paid? What is the methodology? No, so they will check each and every invoice and identify and give a prepare. Then it is prone to clerical mistake. So is it coming out through a mechanism, through a system, in a software itself? If so, what is the parameters which have been defined in the system so that it doesn't go. So you need not check each and every transactions per se. The parameters you can check and compare with the ratios and other things and do a cross checks to ensure. Otherwise, it may be practically difficult for us to check each and every transactions or each and every line of transactions. It is going to be use of technology is going to be much more necessity for the day. Then sometimes some of the record keeping might have been partly online, partly offline, periodically updated, not regularly updated. It is dependent upon. So those are the challenges which you may also come. So where you have to see what is the method they are following as to these type of record keeping is concerned. Sometimes some of the industry you go, they will be having their own industry specific software, especially say you go to a hotel industry. They will have the one specific type of software where the revenues are booked on day end. Actually, from your GST perspective, that revenue will not match at all. But from their perspective, they will be maintaining that particular software based revenue booking and revenue reversals. So if that is the case, then whether that software which are being maintained based on the industry specific software, whether it is compliant from the GST perspective to see all the aspects of the transaction as the time of supply, place of supply is being addressed or not. In fact, it so happened in one of the automobile sector, you are located in Bangalore. Now you are presently working in Pune. Now you go to Pune and you want to buy a car. Today everybody asks you Aadhaar card or election ID. Your election ID is in Bangalore address. The invoice will be raised based on that Bangalore address. Car handed over there, getting registered there in Pune, played in Pune. But what will the software record the transaction as? IGST. Because software says address of the customer and here. So some of the states took it as a major concern because they are losing the revenue. They called all the automobile dealers of that particular state and said, no, this is wrong. You are supposed to change your software and because we are going to lose the revenue. In fact, it's going to get registered in that state in the RTO. It is not even shifted, transferred. So how can? So this is, we say, okay, no, software has come, software has generated a report, we are paying a tax, fine. Software will take what has been given to it. So this is where we have to be careful even while starting to understand the systems and procedure, the checks and balances, whether it is in compliant with the GST at the conceptual level itself. Generally it comes as a concepts, then systems, procedures, then actual transaction level. 3 levels of verification is what might be required. Conceptual understanding, then the system is somewhere wrong or system is correct but the transaction is bypassing the system and being entered. So 3 levels of checks might have to be designed. Again, there may be a situation where in the ERP system we were maintaining, the facility is only to have one user or the code or whatever it is. If all the transactions is maintained under one software for all the multiple locations, but who is having a separate GST and how we are going to segregate is going to be another challenge. I am just listed out a few sample. This is not a exhaustive list. I am just giving you merely a sample so that based on it your thoughts are provoked and you can apply to the situation of each and every client of yours, how it would be. This is merely a theory part of it where the possible audit, now we are not at all concerned with any of the, we are more concerned with the middle part, that is audit by a chart accountant or a cost accountant. This we addressed. we talked about a copy of audited annual accounts, reconciliation statement, and inform GSTR 9C duly certified. The certification they are talking about is only on reconciliation statement under 9C. Audited statement, they are not talking about who has to be audited, whether the audited statement should be from a chartered accountant, and okay, I will engage you as an auditor. You will give a report with lot of comments. I am not happy with your audit report. I am not happy because it is going against me. And I will find one more chartered accountant, get my books of accounts audited by him again. If he gives a favorable report, I will upload him. I will not upload yours. I am just telling that there is no communication of this particular appointment of a particular auditor to any department or thing, so that what you give is, it is not like an annual statutory auditor. Once you already given your appointment, I am not happy with, I will not pay, or I will discard your report, so I will not pay you also. You do not have any statutory legal thing to say that I have given a report and accepted. I will say before you give me a final report, no, I think you are not considered, I will reject your report. So what is the authority or protection given to the auditor, auditor who has been appointed as a auditor here? I will get an audit from you, I am not happy, then I will go to a cost accountant. Now your institute will come out with some guidelines that if you have to do this, you have to do this. Okay, I will go to a cost accountant and get it audited. So what is the protection or what is the sanctity of that particular audit will become a question then. Though it is there in the statute book, the question practically would be, how would the sanctity of it will have to be verified? If I will choose best out of one, so I will get it 5 different people, each one of you audit, which one is best report, I will get submit. No, practically it may not happen, but I am telling the possibility if something happens is no checks and balances designed in the law. So that is the point which I am trying to highlight over here. This turnover I will not get into. The different returns will be dealt in by Venu in the afternoon session. The same slide, what all the returns you all will be filing, with circumstances, how the reconciliation etc. will be done practically, will be dealt in by Venu. Again, annual return, form 9, is it mandatory? Provision says yes, so it is mandatory. Time limit is December, next financial year. Role of annual return, which was there similar to VAT, but the primary questions which are presently lying before the industry is that whether this annual return will give me a window to correct any errors and mistakes I would have done in the normal course and enable me to pay the differential tax or claim the credits which I would have not taken, or any such rectifications is going to be opened up to this annual return is a major question which is lying before the industry. Why is that? Because if it is merely a totaling of our turnovers, every data is there with them already. Department has got all the details already. To sum up in a sum is not a major challenge. Then why would there be again an annual return required if it is merely a totaling and reporting the same thing? So obviously this return should provide for something additional to say that what is that already returned income, what is that now you are declaring, what is the difference, reasons for the difference, and corresponding action, whether payment of tax with interest, with penalty, or claiming back of the refund or whatever it is, has to be enabled is what the request which has been made by the institute to them. I think it's under consideration. We expected shortly to have come, but I think it got a little delayed. Probably within a week's time we are expecting this format will be out. That is what was the thing which we came to know. As per the information we got, the annual return contents is expected to be basic information, consolidation of details of all the supplies made, varieties of the supplies made, outward supply, details of returns from the outward supply, inward supply received, return of inward supply, ITC claimed, reversal, and tax payable, paid, refund claim, sanctions. So essentially it's going to be a summary in one sheet, which is your 240 under the VAT is what the similar terms which they are looking for is what we expect. Preparation for audit and also 9C, the reconciliation, is what is a core content for today's discussion in this. Where all we may have to look at what all the aspects we need to look at carefully, how we can design our audit program, audit checklist. I am just trying to discuss on those lines. Before going to the challenges, some of which was discussed in the morning session, and some of them might have not, but I will highlight those things as well. Computation of turnover limit for eligibility. First of all, is it only for each registration of the state or aggregate turnover of on a PAN basis? Example, my all India basis turnover is 2.5 crores. I have registration in 4 states. None of them individually crosses 2 crores. Should I get my books of accounts audited? Yes. If you see the Act, the 35 talks about only turnover. It doesn't say aggregate turnover in the Act. But in the rules, they use the word aggregate turnover. So the question is whether the rule is overriding the Act and given beyond, or it should be only the turnover in the state is what. But take a conservative view. It has been discussed in the institute as consider that it should be a state level turnover. It's a once your turnover on the all India basis has crossed 2 crores, all the states where you have a registration, or each of the registration you have to get audited under this particular section. That is the conclusion. That is the first primary. When you start itself, entry level itself is a starting with the lack of clarity. Again, already in the morning we were discussing the first quarter turnover should be included or not included. So, if not to be included, whether I need to also file an audit report under the VAT law. When the Act itself is rescinded, ways of power for demanding that type of report.
It is still required because the repealing Act has provided for it.
Repealing has provided for what has been accrued.
173 provided for, aspects relating till the date of repeal, we need to comply.
No, correct. The point which is there, where something which should have been done within that, which has not been done, requires action. One. Second, whatever the liability which has accrued, not paid, is liable to be paid. Is what? Any proceedings against that can be initiated further. But here, me to file audit report due date had not at all come. So my liability to file an audit report or get the books of accounts are not crystallized on the date of that particular sitting. So whether it's applicable is a matter of a debate per se. So let issue kept open per se. Next, various aspects, whether employee canteen facility provided to employee, is it liable for tax or not? Can anybody say conclusively taxable or conclusively say not taxable? Both arguments are there. We do not know what it's ultimately going to stand. Now when we are doing a auditing, what stand we should take? Because we are certifying the correctness of the turnover which should have been in compliance with the law. So whether should we say no, we have taken a stand as is taken by the client, or no, we are taking one stand as an auditor, one client has taken a, so then I cannot say for one client I accept this view, one client I do not accept this view, because each client would have adopted different methodology. And the same auditor doing the audit of two different entities, one entity has taken a stand that it is not to be taxed, another entity has taken a stand as to be taxed. So, are you going to put a note whether 9C will provide for any such notes, or it doesn't give any provision for putting any notes? So, again, please understand that we can always say that this reconciliation statement is being submitted by me to the assessee, not to the government. So in your covering letter, if there is no provision, so you can always put across in a covering letter in what background, in what context you have done this certification. What are all the stands, what are all the views we have taken in which are all the cases. You may have to have a clear-cut notings in your covering letter, or a notes or annexure or appendix to that particular whatever the certification which you are making person.
Would they take a hard copy?
Sorry?
Would they accept a hard copy?
No, I am telling my job to you certification is subject to this.
So are you saying that we could qualify the report with all these reports?
It is not a report, it is merely a certification.
So that certificate, the footnote is that we need to put.
Yeah, we need to put, because there is a lack of clarity in the law itself, and there is no clarity, and you cannot step into the shoes of a departmental officer and decide, no, what you have done is wrong. You have to go by what the stand has been taken, but either you prepare your working papers clearly to that effect, that what is the stand, and take a management representation and go by it, because you are not the authority. They would have taken, so they will take an expert opinion and give it to you. So you are bound by that particular stand which an entity had taken. So you cannot step into the officers and say, no, what you have done is wrong. I am not going to accept this. So you are not doing a reassessment. Our scope is not to do a reassessment of a audit. Reassessment of the whatever the taxes which have been paid. We are only doing a reconciliation of financials and this reconciliation. And
Sir, are you saying that we are saying we are doing that the certification, the above calculation is certified in light of the following ABCD?
First and foremost thing, I don't think that we will have to go to that level, because our job should end, technically speaking, by merely saying, as per the financial this figure, as per the returns this figure, difference is this. Reason for difference, that's all. Reason for difference, if any. I think to that extent only my job should end. I need not go beyond, because that is not what is expected in the reconciliation statement in 9C. That is what is the only thing which needs to be certified. When it comes to auditing, there is nothing, no format, nothing. There you audit and give whatever the comment, audit report. So there you can put all your comments, etc. of annual accounts. There you can give a qualification which is not barred. And again, there it is not a prescribed format. There the physical copies itself may have to be uploaded, because it says submit electronically audited annual accounts, not in any specified form or format.
So now coming to the other point, in the morning session,
Badri.
Mr. Badrinaran was when he is mentioning that suppose a client for which we are doing an audit is having 25 registrations, in say 15 states. We may get an audit for a particular one registration, where your books of accounts or financial is not being available readily in your current my ERP system is not showing me that the business area P&L, say for example. In that case, how you are going to certify?
You are not at all, you cannot start the audit at all. See, if that particular part of it, Again I am splitting further. You may be given only the job of reconciliation statement, not even audit of accounts.
So how should we write the, as per the books, what is the...
No, if you have been given, they should give that. Otherwise, you have to give a disclaimer. Or you are giving whatever the report which you can give them. Because if you see the one of my requirements, prerequisite for an audit, prerequisite, GST and my trial balance is an essential must. Otherwise, of which you cannot proceed further.
This has to be provided by the client.
Yes, obviously. Without client providing this, we cannot proceed further. So, essentially, this is where we are going to start. Okay, I'll go back, since you asked me, I jumped on that.
So that electronical upload, the return has to be submitted. So whether this reconciliation statement has to be taken, hard copy, signed and scanned and uploaded.
Sir, as of now, no information on that.
No,
We
we are
expect-
submitting the report to my client.
No,
But
I-
hard copy, I am signing it, giving him.
9C format, once it gets notified and the methodology of uploading notified, then only we will get to know. Till then we may not know. If they do it like any other form, online only you have to fill up, or you are going to fill up an attachment, or are they going to upload an attachment. I think essentially it is going to be an attachment format, the reason being accounts and everything are being or they may for the reconciliation alone, online they may have to do. A certification through your DSCA code of a chartered accountant may come into picture over there. But all others, there is nothing, no format, so online may not be, a physical copy may have to be enclosed. Okay? Yeah, lack of clarity, which I told, because of these frequent changes, notifications coming in, updation, how much we have updated, how much we would have missed out, how much of which we are aware of, how much of it we may not be aware of. Lot of changes, lot of things. And in fact, recently I was just having a discussion with one of the sir, for this canteen thing, we have come out with very fantastic scheme. So, we take a credit, we charge, instead of our cost 100 rupees per meal, we charge 25 rupees. Since we are charging 25 rupees, I take 100 rupees credit and I enjoy the credit because I am not covered by the restriction. I think so. Please wait. First of all, for you availing that benefit of 5% concessional rate, you cannot take input tax. So that input tax itself is wrong. Second, the question of you, if you are decided to charge, first of all, the charge itself the question. If you are decided to charge it as a supply, employer-employee being related, your valuation of 25 rupees is not acceptable. You have to go with the market value, which is at least 100 rupees. So if you are charging, charge 100 rupees. So if you charge 100 rupees, assuming that credit is also eligible, which is again a question mark, this type of turnover will be treated as exempt supply by virtue of explanation and notification. Since it is exempted, while computing your common eligible input credit, the proportionate credit relating to this turnover also has to be additionally reversed. So one issue, there is so much complications, and many people would have taken different view. Somebody is charging 100, somebody is not charging, somebody is charging 18% with full 18% credit. There is a multiple practices. Whose practice is right, whose practice is wrong? Which one you are going to adopt is going to be a question mark which you will come across. At which point you have to take certain stand and note that particular thing. Coming into the procedural aspect and the reconciliation issue, always the morning session, so we were discussing, he had uploaded, I have not taken credit, I have taken credit, he has not uploaded. Some things he has also not uploaded, I have also not taken. Because it has not come. So that's what Badri was telling. If everything is matching, there is something wrong. Unless you see their systems are so robust that it matches. Automatically it's very unlikely that both matches. So that is where the problem comes in. So I think and lot of input tax credits eligible, not eligible, all those questions will come. Again, complex in the procedural form, reliability of audit software which they be using is some of the software which they are using may not be tested. Even somebody may say, no, I'm just going to give you a GST audit software, new tool I have developed. To what extent it is, capable of handling all the situation. He is also doing a trial and error probably. So we are guinea pigs for them. So I think volumes procedure. I think you go and ask on a reverse charge basis how many of them are raising up a self-purchase invoice. What is self-purchase invoice? Will be a first question to ask. So all this is there. My point why I am highlighting this is these are all the issues which are there. But is it there which is covered within our scope? If it is not within our scope, then why should we be looking into it or trying to? Okay, as a management, as a value addition, we can surely suggest. But as a certifying auditor, what is my scope? We should understand it clear and better once these forms and all those things comes in. Based on that, I think you need to agree into your scope document with the client. Transition is one more thing. There is going to be an old regime, new regime. So you should have a proper cutoff as on 30th June. Some transactions should have got spilled over subsequently, but which is going to have an effect for the past. The effect of that transactions given as on 30th June or subsequently. So those reconciliations and on cutoff is going to be there. And at the same time, closing out all the service tax payable account, input tax, service tax credit account, the liability account, refund claim account, everything has to be reconciled as on 30th June. And one cutoff has to be drawn and reconciliation to the returns of the respective periods under the VAT or excise or service tax law had to be drawn and checked. Then we have to take further. We cannot only see GST closing balances on 31st March. I am talking this not only from the GST audit perspective, even from the regular audit perspective. Because some of the clients when recently even the audits got, balance sheet was finalized, they sent us for someone who said our draft return. We saw there is on the current assets, service tax credit receivable, service tax liability payable. Because those accounts have not been closed, squared off, still it is open. So those are the things which would have not considered or left out. So I think usually they would have reconciled the GST figures are matching, but that cut-off figures are not matching. If something which they can't take a credit, they would have not carried forward in the transitional GST, Tran 1, they may have to forego if they decide to forego, charge it to expenditure account and cannot carry forward because there is no more receivable. Some refunds which were already discussed and all the pending cases which were there in the past, high time to scrutinize and see whatever the claims which they were showing in the asset side, whether they are really receivable, if so, how much to be accounted, how much to be provision to be made or written off. So those aspects is a high time to clean the financial from the old tax perspective as well. Send advances. Somebody was telling sundry creditors write back in the morning session. Yes, write back is fine. Write back is of which period? Now I am going to write back in say for this October 2018, 5 lakh rupees. Part of it is pre-GST, part of it is post-GST. So pre-GST whether GST applies. Post-GST anyway you are denied with the input tax. When you write back, again, it's a voluntary write back or a mutually agreed write back. What difference does it make? No, say no, I agree to forego and tolerate your thing, your consideration. Department may come with some different angle to that effect and all those things. Be careful about it, that's all. But actually, they, as Badri also said, write backs there is no provision per se. Extending that, I pay you some advance for you to do, you are an artist, I will give you some advance. Say, please come and do a show for me. I paid you advance 20,000 rupees or 5 lakh rupees. I did not turn back to your call. Show got cancelled because I did not come back. Can we treat it as a tolerance? An act of tolerance, so that for this consideration is for tolerating an act of cancellation? No. Neither he cancelled or something. He gave money, I think, but subsequently didn't come. I did not supply it at all. So therefore there is no supply. Therefore that is not at all a taxable supply. Extending that right back to this scenario. But on the I come and say, no sir, I am cancelling. No, I will not give you back the advance because I told in the notes, if you cancel any advance, we will deduct 20% or 30%. That 20% is for agreeing to tolerate a situation, agreeing to tolerate an act. Therefore, it is supplied. The department can take a stand. Again, legally whether it is withstandable or not is a one more big question mark. But nevertheless, there if there is an agreement is one scenario. If there is no agreement is another scenario. So there cannot be a uniform thing all across which can be said to be applicable. Okay. Opening balances as on 30th June, what is the credit implications, whether old credits were taken, not taken, reconciliation, cut off. Essentially what is happening is, within the same financial year, we may have to do a two cut-off verifications, one on 30th June and one as 31st March. So the first year, if you are taking accepting audit also, there is going to be additional verification, like we check opening balance per se, etc. Anti-profiteering is a one more thing which there may not be a requirement for certified, but nevertheless which may have to be looked into from the management perspective, whether they complied or not complied. If they are not complied, what is the action plan which we need to suggest for them? So all those questions do come because there is no statutory thing binding on them anyway, unless somebody complains against somebody of anti-profiteering. There is no action per se is envisaged. Now, as I said, practically when we take up the audit per se, where to start with, but I did mention about it. Okay, you are starting an audit with other balance sheets, etc., audit, fine. But before that, now we have to have from the GST perspective what are the prerequisites. We need to have a GST and trial balance, output liability register, as well as your tax payable, which will be having a on supplies, on reverse charge, all the tax which is payable by you on that registration. Input tax credit register, invoice register also is required there, stock register for which maintains the stock details of inputs, finished goods, as well as engine sent to job work, received back, all those things. Form 3B obviously which is required for us, GSTR 1 which you have filed with the SCS filed, then GSTR 2A where my credit eligibility is being reflected, reverse charge register where you record all your reverse charge liabilities or reverse charge where you are liable to pay tax, cash ledger, credit ledger for last year, that is the previous financial year, books of accounts which maintains in general for that particular entity, as well as most focus to this particular registration. In fact, when the GST implementation stage was there, always there was a question which used to be there, whether should I maintain all the books on a e-GST registration wise, though there was no specific registration wise requirement per se, but future audit perspective and all those things, always it was suggested for bigger entities to have a bifurcation or a mark or a identification code at whatever the transaction level in the system to mark for that particular GSTN or the division or whatever it is. some of the aspects in each of the element of your financial statements which requires attention. Again, these are merely few examples, not exhaustive, to just give you an idea about it. So if you are reviewing the financials, why on the share capital, when you are looking for it, what all you may have to look at. Why do we look at the share capital? One, to see whether there is any related party. Somebody is holding shares and who has become a related party by virtue of a shareholding in this entity. So the shareholding pattern, you may have to look at it and examine who are the shareholders, how are they connected, whether there is any transaction with those parties which requires a special addressing as to valuation or a transaction which is there. All those questions will have to be designed. Issue or buyback of share capital. If you are buying back a share capital or issuing a share capital, the question is, it's a share exempted or a non-taxable supply, securities. So your input tax, anything relating to issue of shares or buyback of shares, expenses may become an ineligible credit. Input credit. Private placements of a capital, whether it will be treated as a security, first question mark. If so, what is the expenditure incurred for that? Whether that credit relating to that becomes reversible, ineligible. So these aspects would have not come in a normal course. Everybody says, okay, input tax, take all, it's in the course of business, yes, take. But this is where some things which is beyond a normal type of transaction which requires attention per se. Sometimes the share capital is issued on as a self-fed equity, or you incorporate, you pay them in a kind. So there, whether supply happens, registered person, unregistered person, reverse charge, as a professional, whether it's a legal service, am I liable to pay tax on it? So in kind. So where any survey, issue of a shares against a kind, liability on me, liability on him, whether there's a tax clause in that agreement which will create a liability on me, so how it has to be dealt with. So those are the factors which requires to be looked into as well. Short-term and long-term loans, the facilities, whether it's an entity as a whole or it is specific to a location. How does it matter? If I have taken a finance for the entire country as a whole, okay, I have taken 100 crore funding facility at my corporate office at Bombay, but projects are happening in 3 different states. Interest no issue, but this funding, the charges paid for this funding, the initial sanctions or all this expenditure would have suffered the tax. That input tax credit cannot sit only at Bombay. Either it should get cross charge or ISD distributed. Okay, so where we will have to look at that facilities, the charges. So we may not have thought of that level of allocation. But I have said, okay, it's common thing, but these type of things also does matter. If it's specific to a specific state, then obviously you should transfer that cross charge that particular thing or ISD transfer to that effect. Securities offered, basically securities in the sense guarantees, sureties by the subsidiary company, holding company. They may not charge anything for it, right? They being a related parties, it shall be treated as supply between the holding company to the subsidiary company for giving a guarantee or a surety, which if it was some third party, they would have charged a guarantee fee or whatever it is. So that may be considered as a consideration for the supply. So there may be some issues which may request attention per se. Intercorporate loan, again related parties, whether accounted, then it's an exempt supply interest. So then thereby the input tax reversals will come into picture. Okay, so if it's a constructions, then the capitalization, where we have capitalized, what are the capitalization, whether expense, input tax eligibility would have to be looked into. When it comes to trade payables, essentially the aging 180 days for eligibility of a credit, whether we have taken a credit, reversing subsequently when we have to take a credit, whether there is a system of reversing first of all. If the reversing is there subsequently, is there a mechanism to re-avail on making a payment? If so, what is the method, and if it is not done, what are the checks and balances to report that in the system is something which we may have to look at. Advances received from the customers. So, should we pay tax? Huh?
Suspended for
Goods suspended. Services there. So, if it's a combination of goods and services, then you have to identify the supply of goods and supply of service. If it comes to supply of service, you have to pay. No, now I am supplying independently goods, independently services, but I give advance as a lump sum. As and when billed, that will be adjusted out of it. First of all, is it an advance or is it a deposit? Trade deposit. Why I am asking this question is, we loosely use the word advances. In the context of the GST, again deposit, once we use the word deposit, whether my provisions of the Companies Act is going to apply, barring me to take accept a deposit. Whether deposit what is covered in the Companies Act, is it restricting these type of deposits, which is actually not an advance, but not in a true sense a deposit what the Companies Law is envisaging. It is somewhere in between, but can be considered as a deposit for the purpose of GST law. Why? What is the difference? In the GST, deposit means it is not allocated to a particular supply, but it is given to you as an amount to keep it, and as and when you bill, you get adjusted out of it. So in such a scenario, the time of supply is only when the advance is adjusted against the supply. Till then it is not a time of supply, the tax liability will not get attracted. So your nomenclature in the accounts may have a repercussion over that. Again, when it comes to liability registers, your reconciliation between your financial liability register as a return, whether it's being matched pre-GST, post-GST, all those we already talked about. Associated enterprises, any provisions made, then since associated enterprise, the liability would have accrued as the time of supply on the date of provision, so the tax liability is created to that effect. So like that, RCM time liability may get dipped. When it comes to fixed asset, whether the input tax credit is properly availed, if something has been missed out, those verifications all in part of it, whether they have claimed depreciation as well as ITC, benefit of the tax. So whether something is capitalized, not capitalized, because the definition of a capital goods depend upon that. Okay, since at this stage only answering, I want to ask some question. What is the difference between a capital goods and inputs from the context of taking ITC credit? I receive a capital goods, I receive an input. Both are eligible to take an input tax credit. At the time of receipt itself, correct? and are subject to payment, etc. Then why is the difference between the two?
5 years. 5 years.
Section 18 and Rule 42.
Why is it required? In which circumstances it is required?
And there is an exempted supply.
Only when there is an exempted supplies, it makes a difference. If there is no exempt supplies at all, it really doesn't matter.
Otherwise also when they supply.
Resupply. There only the proportionate thing will come into picture to work out the benefit. Why I am saying this is, in case of a capital goods, there is a complicated input tax credit mechanism which I don't think many of us are familiar with. It's worth discussing that. Say I took a capital goods today, took a credit of 10 lakh rupees, 5 lakh today. No doubt I can take properly away, no issue at all. But when it comes to my output tax liabilities, since it is a common input tax, if it is used for common for both taxable and exempted, I have to work out the proportion and I have to relate it to exempted turnover. I have to pay whatever the credit I have taken. There it says whatever 5 lakh divided by 60. This is per month apportionment. So that into that month's exempted turnover is what I have to pay back. I took entire 5 lakh, month on month, 5 lakh divided by 60 into that month's exempted turnover proportion, you have to pay back. Okay sir, you have taken you. No, pay back with interest every month. Next month, 2 months interest. Next month, 3 months interest. Next month, 4 months interest for that amount. After this, annually, you recompute the turnover. Okay? So I am only just trying to tell how many assessees would have followed this.
Actually for capital goods that
Annual, no, it's only for input, sorry. Capital goods is month on month you reverse, that's sufficient, it ends with that. In case of inputs, you have to do annual computation per se, rule 6. But I am just telling, let me tell you, at least 90% or 95% of the assessees would have not done these workings. If anybody, then there is actually a liability which is created with the cost attached to it with as an interest. So be careful that this particular things would have not been forthcoming anywhere in your normal verification.
For banks and NBFCs,
There is a fixed percentage
50% reversal.
that they follow, that is enough. There is no need of following this. I am doing general assessments.
So, can you come again? I didn't come.
I will explain the post lunch. In the lunch time I will explain separately because I do not have time to cover other things. Next is sales tax paid on the fixed assets which is purchased pre-GST but sold post-GST, the implications. Then written off, assets written off, ITC reversal is required to be made. Then there is also one asset purchased in one state, moved to another state. So stock transfer, there is a requirement of payment of tax and doing a stock transfer. So which you would have not thought. Okay, branch to branch, send it. Some people would have taken a separate business vertical registration. There again, one entity to another entity transfers will also have a lot of repercussion. Sometimes some intangible assets also will be there. Usage of that also will have a lot of challenges. Say you have purchased some asset on which you would have taken an input tax, like software or any other technical know-how, that being used by across all the branches, then what is the consideration for that will become a question. So utilizing a technical know among the branches obtained by one entity, one head office will have a then work.
CWP credit you are saying.
Next, I have not come to it.
Sir, in the slide TV you mentioned sale of TV, used TV by
No, it's not TV, it's a transaction value. Transaction value versus percentage reduction. Basically what my friend was telling that the capital goods is used and then subsequently sold. It was sold for a X price.
Since it is on sale, the used asset, in case of a hotel, the used asset like computers or TVs, you treat them as sale of assets as such as e-waste, because e-waste there is a notification, and used assets, some of the used assets which may fall under the used as this e-waste notification, how do we fix that?
Okay, no, I'll address your first part. There are two parts to your thing. First part is concerned any used assets being sold. Part 1, it was purchased pre-GST. So the question of they apply the percentages and all those things doesn't arise. On sale, on transaction value, you pay tax. So you sell as a sale, on that value you pay. Again, there may be a question in the past law you have taken a credit, whether that law continues. I don't think there is any record, so we can ignore that part of it. Second, you have taken a GST credit. Once you have taken a GST credit, if you have capitalized that particular goods as an asset, then it becomes a capital goods. Once it's a capital goods, irrespective of your selling price, you have to adopt that percentage deduction which is there and arrive at what is the reversal which you are supposed to make or the transaction value whichever is higher. So you may sell your transaction thing, but reversal perspective, that is what we will be adopting. Because again, there is a conflict between two rules over there in that drafting, but nevertheless you can adopt this.
In this case, there is a requirement of HSN wise comparison or HSN wise tallying
for capital goods.
For anything. See, what happens is that generally when the small trader is getting something, in their purchase rate there will be some HSN number. When they are selling their
I'll address his question is basically to what extent the importance of this HS code is relevant in this particular law. One, the HSN is relevant for determining the tax rate, applicable tax rate. You cannot compromise on that. If a particular goods is falling under a particular heading, you have no choice but to classify that and pay tax on that head. Maybe situation may arise where both are falling the same rate, so it may not have repercussion. If you are wrongly mentioned, it becomes a procedural in nature, but nevertheless the tax would have been under that particular original applicable classification. But once it comes to availment of input tax from the recipient perspective, it is more to do with the usage rather than the classification. I repeat, from the recipient side, it is more to do with the usage and type of usage, because the restriction and all is based on the type of usage, never linked to the classification of goods or services. So therefore on the recipient side, it's always your usage what matters. Number one, coming to capital work in progress is concerned, there may be a separate relation for land, building, as well as for plant and machinery. There will be some issues relating to input tax credit when it's a combined thing, when it's a separated one, whether I can take the especially ITC credit. I am not going in detail into that particular thing because ITC credit on construction sector itself is a big discussion.
No, CWP itself, it cannot be taxed always capital because it's not capital expenditure. On the other side, okay, I will take it as inputs, but later I may capitalize it. So
it is treated as a capital goods in my view. Finally, it's going to get capitalized. Capital work in progress is meant to be capitalized, so it's a capitalized unit. It is a capital asset.
Promoting on the reversal of the 85 capital goods which I use and I reverse certain percentage of credit. How do I record it in the invoice, because that may not be exactly the 18 or 12 or 28%.
Not.
But will there be any implications on the return? Because returns gives me only the defined percentage.
No, basically his question is, there are standard rates, but whereas it may not match the rates, but it is based on over a different percentage. So if the return is not providing for it, it should provide. It is not provided, you put whatever the applicable tax which is important, corresponding to value segregate and write a mail to this GST to enable that particular.
Even the invoice does not have.
Invoice also doesn't matter. It's your own document. You write whatever the thing. It is not based on rule so and so computation.
It may end up being 17.5%.
Yes.
Excuse me, sir. Suppose now we have sold one vehicle as a fixed assets. There is a margin concept is there.
I think I will take that question later because this is not specific. We are diverting from an audit to specific issues. Okay.
But says before GST.
No, I will just take that later. I said in the last session. Okay. Scrutiny of all expenses to eligibility. This is what may be there. Trade receivables, where in case of exports, one of the important factors that you are supposed to realize the foreign currency. If you are not realizing, there may be it will be not treated as export. If it is not treated as export, you may have to pay tax. Forget about being relaxed. You have to pay tax. So that is going to be a challenge. So receipt of foreign currency on export of services is one of the important factors which people should not forget upon. In case of bad debts, you will not get a benefit of credit. Whatever the tax you have paid is gone. Not only the amount gone, even the tax also gone. Merely by the fact that you have written off, you will not get back the tax. So that is the thing. Somebody was asking about the morning session about credit note, debit note. Actually, the non-GST, we use the word non-GST credit note, debit note, which in other words we also call it as a financial debit note, financial credit note, which may not have a GST per se. In the practical side of it, most of the people have now designed their transactions in such a way that there will not be a debit note, credit note, especially between the B2B transactions. They will ask them to raise an invoice so that they can take a credit. Other ways of which there may be a multiple issues which will arise. One, I may not get input tax. If I only issue a financial credit note, I have not made a full payment for that particular invoice. Though there is an argument to say that when I am not required to pay, if I don't pay it is, but department can always say your bill value was 100, but you paid only 90. So 10 rupees which you have issued a credit note, you will not be eligible for the input tax credit. Rather than that, you take and let him invoice for that whatever, you invoice for that 10 rupees and collect the tax. So you will get full 100, he will get on 10. So effectively your financial transactions also get nullified. It will be called as sales promotion contract or sales marketing or whatever the new contracts are being entered into in the business. Rather than saying a discount mechanism, they are calling it as a incentive schemes where or promotion schemes where it will be treated as a separate independent supply than that of the original supply which would have happened. So that the documentation, procedures become much more simpler and easier, especially the provisions which was containing that you are supposed to give an invoice-wise reference for each and every invoice raised earlier. So that is going to get relaxed. In fact, the latest amendment has relaxed that provision is what was said. Next, inventories. Valuation of inventories is going to be a lot of challenges. Stock differences. I think how many of you would have read the newspaper on this Kerala flood issues. There was also a document which was floating which was said now that the goods are destroyed, all of them are required to reverse the input tax credit.
Notices are being sent.
Huh?
Department was sending notices to them.
Whether they are sent or not, that is what is being circulated, they are preparing to send. They lost the goods, now they are saying, okay, you lost the goods, fantastic, Now whatever you quantify what is the extent of the loss of goods, out of that how much was the input tax await goods, and quantify that and reverse the input tax, otherwise of which we will take a recovery action. And one of these circular to what is in the June, I don't know, they say you may not find the assessees in their place, so you prepare a notice and stick onto your wall, if wall is existing. No, I am just telling how rigorous the law can be. It doesn't have any thing. So this was said because legally they are entitled to recover. So the law has to come out and give a special relaxation if they want to give, with amendment to the act only. Then invariably the stock taking exercise or annual stock adjustments is something which you might merely you take stock details as is being given by the management. But what happens to the difference between the stock, book stock versus a physical stock? The differences can be for varied reasons. One is improper entries. One stock there is an excess, one stock there is a shortage. So here generally there is a methodology which they do a reconciliation and pass a correction entries. After having passed the correction entry, then an adjustment entry is passed for the actual shortages. So there may be a GST implication which you should take care of. Okay. Other current assets, all the accumulated credits, refund for it. There may be some off the balance sheet items which may require attention as well. Scheduled related party transactions, some of the notes to accounts you may get to know. These are all the points which you need to look at it. Then GST versus accounting standard versus Companies Act. The definition of related party as per the Companies Act is different, as per the income tax is different, as per the GST law is furthermore different. So merely by the fact that somebody is defined as a related party, in one of them need not be a related party there. So why I am saying that is, you see the balance notes account, so this party is not related as per the Companies Act, so they are not reported. But from the GST angle they may be related. So in such a scenario you have to extend your checks to see whether that is covered or not covered. Contingent liability, you may have to look at those as well. Income and expense in foreign currency, that will give a lot of insight for you to see whether reverse charge liability on import of such will discharge or not. Then income tax disputes, if there is any as far as the expenses disallowance is concerned, that may have an equal repercussion in the GST as well, because now more or less in the course of furtherance of business, which is more or less in line with your income tax deduction provision, general deduction provision, the expenditure. So 37, maybe those case laws, those things may be relevant in this context. Obviously, past cases which may have a similar repercussion thing will have to look into. Profit and loss account, I think I will not go into many of this because this will have to be dealt with in reconciliation session by Venu. But just I have listed out, this is there in the presentation which can be made use of by you. Why it should be not be included, excluded, etc. Sometimes the expenses would have been netted off with some incomes. So that is where your attention may be required per se while scrutinizing this. RCM liability up to October 12, many would have not complied. If you ask me should I comply, I have no answer on this stage. Somebody in the break asked me the missed credits and all those things. Do exercise away. The transitional credits, what should be done? Should we take, not take? If you are clear that for technical reason was not permitted, what it should be done. So at least as one of the aspects which Badri was mentioning also, wherever you have some issue, avail and reverse it, so that you record that particular eligibility within this financial year. Subsequently, you might claim refund only within 2 years, not beyond 2 years. because there is no concept of protest, unlike earlier law, which was time limit is to go for whatever the time. Now 2 years, any refunds has to freeze from that particular transaction. So in the GST, everything is time bound. If you misses out time, you do not comply within the time limit, you may face a lot of issues. At least last 1 month, at least 20 calls I have got from different places. Small people, not big entities, especially mobilizers. Sir, I have not filed my return since GST. You can file now, no? All the returns. I said, yes, you can file, sir, no problem. However, you will be liable for late fee. Huh? How much? Per return, this much. Sir, my liability itself, each one may be 1,000 rupees, 2,000 rupees. I can't help you. This is what the law says. I am telling it doesn't have any logic behind it. There is no outer cap for it. Even nil return, they are putting a smaller figure. So, I am telling unless somebody challenges this provision in the court of law, it is binding. So, I am sure at least 30% minimum of the registered GST taxpayers would have not filed their return, whose liabilities culminated maybe in crores as a late fee. Okay, I think that is where we are to, and again the problem is, sir, Halledella nan kattak duddilla, I don't have money to pay for the past. Can I file current month's return and go ahead? So law is forcing you to default further. You defaulted past, you don't have avenue to pay that money, so it is making you to be a continued defaulter forever because you are not paid for the past. So I think that is where you have to be very careful about. Personal consumption, only one aspect I want to just highlight. In case of a corporates, what is personal consumption? Just a question for you, think over, let's have a discussion in the end. I'll just quickly run through the way in which you can design your audit program, what all it should cover, what all you can design in it. One, basically a general profile of the SC, brief nature of the business of the SSC, registration details, then list of accounts and records maintained and the information regarding the software which they will be maintaining, details of outward supply, type of outward supplies, export, what are all the things, which are the nature of transactions they may be attracted with. So you can have a brief sheet to maintain this a master file to have a basic information about the client master data, then details of outward supply involving works contract, composite supply, mixed supply and continuous supply. Basically one Excel sheet giving out each type of transaction and the corresponding tax statement can be compiled and kept for a reference, so that it will be easier for them for reference why that stand was taken at any given point in time. Classification of the goods and the rate on all outward supplies, applicable provisions of the place of supply for all of them. Basically list out your each type of outward supply and inward supply, and for against that what is the place of supply, what is the time of supply, then what is the rate of tax, what is the valuation methodology. The rate of tax is by virtue of a corresponding reference of that particular notification or the schedule reference number, and if it is exempted, by which exemption notification. There is some circular reference against that. This master data, if you can enable to be maintained by a particular client, that is going to be easily a reference document at any given point in time for somebody to look back why such stand was taken. If any changes is there, you can insert one more row and add from which date that stand is taken and why. So that will help anybody to have a proper understanding of any stand taken. Okay. Then transaction value, what is to be included, excluded, conditions of input tax, proportionality, when to apply, all those things. Details of goods sent to job work, input service distributor vis-a-vis cross charge. When it should be ISD, when it should be a cross charge. A very thin line between the same, because a lot of doubts do exist. Okay, we will discuss this issue specifically in the last session in the panel discussion, because when ISD will come, when a cross charge has to come, whether one can substitute other or it is independent of each other. These issues we will discuss that. Okay. Exemption claim, compliance. If any exemptions are subject to conditions, whether conditions have been fulfilled or being fulfilled or not has to be noted. Then payment of taxes, methodology, refund claim, compliances, what are all the conditions to claim refund, it is met or not, because somebody will say you charge IGST and export and take a refund of it. But somebody has obtained their inputs from another EOU unit who has availed the benefit of importation without payment of IGST, then you cannot do that. If you are doing your entire IGST refund claim may be question mark. Okay, so there will be small conditions hidden. Not hidden, it will be there. You are not read. It will be missed out in between. So you should be very careful about it. Departmental correspondences, ratios, verification of all departmental correspondences, and also please note, many of the assessors would have got the notices for non-filing of the returns beyond 3 months. Then within 15 days if they don't file, they would have got the order itself. It will be just like a letter through mail to account. If you do not file your return within 30 days from the date of that particular order, that order becomes final unless you appeal within a period of 3 months plus 1 month, 4 months. So these are the time bound. Beyond that 4 months you cannot get the condonation unless you go to High Court and get it condoned. No appeal-led authority can condone the delay beyond 3 months plus 1 month, 4 months for a first appellate authority. So this is a statutory time limit, which the decisions are clear in the indirect tax laws, saying that once the law has prescribed a particular time limit for the condonation of delay for appellate authority, he do not have a power to condone the delay beyond that much period. So thereby it becomes freezed. Your order becomes final. Then the recovery starts. Once recovery starts, you have no other option but to pay. So these aspects many of the assessees would have not been aware of. So make sure that this is brought to their knowledge. So then you have to run to the High Court directly in a writ petition, not in appeal mechanism. You have to file a writ. Even if you file appeal to the next appellate authority, they will simply reject as barred by limitation. Okay. Next is ratio analysis. Basically, you may design understanding, attention to transaction of specific thing. This is the same thing which I have given much more thing. Some issues I have listed out which may be practical. I know that I couldn't cover all this thing, but once you go back with this thing, it can be a reference material for you. With this last slide, I will conclude my session. Auditors should take care. Engagement letter with the auditee with a clear-cut scope. Representation letter with the management. Wherever you are having a certain clarity required from the client side or certain which you cannot verify. So that you can recent updates in the audit provisions or the things what are all happening. Then proper staff with the technical competence is a must. Continuous evaluation of the knowledge of the GST. If you can get a proper software for using the methodology to reconcile all those, check the transactions, etc. Then discussion with various professional colleagues for a better understanding would have handled, and it is generally suggested that you can form a group within your known circle to have a study circle meetings to have until these things get used to or get settled. Create a groups among yourself and have a discussion forum for a better use of everybody. It is a mutual help and mutual strengthening for all of you. Okay. With this, I conclude my topic. I think 2 minutes left. Everybody is hungry, I remember. I once again thank each one of you for a patient listening. And again, I thank Branch, especially Shivram, for giving a wonderful introduction. Thank you.
That's all about Rajesh. Whenever he takes over the stage till to the conclusion and up to the last minute of the session time allotted, he keeps every one of you engaged. So thank you very much, Rajesh, for nicely handling this session. And I request Nagaraj to come forward and present a memento to Rajesh Kumar T.R. as a token of our appreciation and gratitude. Friends, let us break for lunch and assemble back by 2 o'clock.